Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I am a mediator and valuation expert in St. Louis, Missouri. So I am starting a new kind of case study review, expert insights, and Michael Koeppel has really had a tremendous amount of experience, 30 years of experience, not only working in a bunch of industries, but focusing on technology. He has a wealth of knowledge around AI and IP, also manufacturing and service organizations. So he founded eCapital Financing, which helps startups in LA area and Western New York regions, but he also owns Lakelet Advisory Group located in New York. And in this series, we're going to explore various valuation case studies, highlighting unique challenges and strategies for each case. So this will be a little bit geared towards some of our professionals and practitioners. But quite frankly, I think what we've learned is that most people can enjoy or gain knowledge from other people, experience, case studies, cases, and knowledge that we've acquired, sometimes by making mistakes, but for the most part, adequately and successfully advocating and helping our clients. So big picture though, a valuator and valuation professionals typically have to be neutral and unbiased and looking at things without that lens of advocating, right? So that was a little bit of a trick to see if you guys had caught that, but I don't know if anybody did. So in the expert world, we're not there to advocate. We're not there to even win cases for our clients. We're really there to support valuation theory and then to supply some evidence and documentation that tells the financial story for those people. So Michael, welcome. I can't wait to get started on this. How are you doing today?
Melissa, it's always a pleasure to talk to you and your team, and I look forward to this podcast and podcast series.
Well, and when we were talking, we were like, Michael, do you have any case studies that you've put together? And like, oh yes, of course, like tens, hundreds, thousands, who knows how many. So he gave us a sample of some of them, and I thought that some of them were very interesting. So we're going to be covering them in smaller podcast format, but really talking about the specific case. Now, the first one that I did want to talk about has to do with partner disputes, but we might kind of blend two case studies for this one. And I want to start out with partner disputes because I think in the valuation world, you know, we typically will start out doing maybe estate planning or valuations for the IRS or for gifting and things like that. But what happens, and those are very long reports, like those are extensive reports that need to be supported because you're filing S-election or you're gifting some shares to family members. And you want that to be documented and even set the statute of limitations so that you preserve that with a, you know, gift tax return and such. But when we're talking about what people and business owners really need in this space is a lot of times we are needing to separate the partnership. And for the most part, we don't need these huge valuations. We need something between like a rough and dirty back of the napkin number and these huge valuations. And so when we're looking at this, we're seeing a lot of these partnership disputes fall into mediation, arbitration, or sometimes the partners are like, oh, I can just use my accountant or financial planner. They know somebody who did a valuation once. And so they're really not being guided in this space. And so I want to first just kind of start to talk about some of the issues that you're commonly seeing, because what we do a lot is go to court and not just go to court and try to mediate things, but also try to testify and really proactively defend the valuation that we prepared. So what are some of the issues that you're seeing around partner disputes, either in litigation, mediation, or combinations of all of them that you think are pretty different than maybe in the past?
Yeah, with partner disputes, I would say, Melissa, there's really two tracks. Track A, for lack of a better term, would be when there's no formal agreement as to what happens in the event of a dissolution. They've been together for years and one wants to retire or for whatever reason against the other. And the second case is where there is a section in the agreement as to what happens in the dissolution, but that is either so vague or has not been updated in years. And sometimes the ones that are vague and not been updated in years are cause more problem because there's really a total misunderstanding of what the individuals want and or need in the partner dissolution. The partnership, though, can be a little bit different and easier to work with than a dissolution, for example, in a marriage, because most of the time for partner dissolution, it's based on economics. And, you get the family law, and sometimes the economics are secondary to the personal characteristics of the individuals involved. But the key is to understand what the partners went into the partnership for, what the goal is. Measure what their peers do. The income, usually use the income approach for, I would say, 95% of the partnership dissolution. And again, as you previously stated, and accurately so, we're the referee. We're not taking sides or advocating partner A or partner B or a group of partners. And sometimes the partner disputes is not totally a dissolution. I mean, you have partners, for example, with the one firm we're working with right now, the senior partners have a totally different understanding of how the distribution should be made than the young kids, the younger partners in there. They have different expectations. They don't want to be allocating all this money to the pension and everything else of the senior partner. And it's a gray area of how that has to be accommodated. So they want someone totally neutral to come in there, and you have to meet with all the parties, document it, and find out, okay, this is the path going forward, and this is the value, the quantitative value that we assign to it. The one thing that I would suggest, though, for people going through this process is to meet with the players often. Don't have a report and then go back to all the parties. Both sides will say they don't understand where it's coming from. You can meet with them separately if it's a contentious relationship, but meet with them a couple times and say, per my understanding of talking to the people, per your original agreement, per everything else in here, this is what I understand it to be. And then document that. Then go to the other side and do the same thing and compare notes, because the basic foundation, more times than not, is the lack of communications is the biggest challenge. One partner always thought, well, the EBITDA or whatever should be calculated as X, Y, and Z. And you talked and said, well, I didn't think Z should be included because that's discretionary. And that conversation can save a lot of frustration for the valuator as well as for your clients.
Well, and to piggyback upon that, I think that's very interesting, because I think that the interpretation or the perspective about the buy sell, and it's almost like they read it one time, right? Way back when, and they have this perception of like, well, it said, we would take EBITDA and multiply it by this, or it said, because a lot of times these buy sells, which I think Chris Mercer has always had, like resources of how to review buy sell agreements, and how to look at them and have partners understand what this issue is. A lot of times we're not necessarily seeing the partner disputes go straight to the court system. This is a difference. Like in marital divorce, you go straight to the court system, you call the attorneys. A lot of time in these partner disputes, we're not seeing them reach out to attorneys or try to get things done. Sometimes they're working together. And like, even as we created valuation mediation, that was the goal, is to not only meet with them, but to have a process to meet with them together and basically say, hey, the company is going to hire us and you two are both partners. And yes, one of you is going to stay in, or even one of you has been putting money into that. Usually one partner putting money in and one partner's like, I'm still not getting the benefits, so I want to exit and they owe me something, right? And then the other partner's like, I've been putting all this money in. Why would I give you more money to exit? But the buy sell or the operating agreements dictate this sort of protective measure of buying in or out. And so that's what you're saying. You come in and interpret it from a business valuation standpoint and kind of come back to them and say, hey, here's my thoughts for it. A lot of times, what are they going to say? Well, that's too low.
Yeah.
That's not high enough. Are you sure? And then if you're on the other side, that's too high. There's no value there. Are you sure?
Sometimes you think that's when you do a good job, when the two of them say the complete opposite ends of the spectrum. But it's the communication. And you also have to remember, and the most important thing is, when they originally put these buy-sell agreements or the partnership agreements in places, everybody's so happy. It's like a honeymoon period. They don't think of, okay, let's focus on the dissolution for the rainy day when things go wrong. And a big challenge is, a lot of times, and he's got to handle it with the state, if one of the senior partners passes away or something happens to him or her, okay, he or she may have known the intentions of what to do with the partners, but the estate doesn't, or the junior partners don't know what happened on day one when they founded the partner. And they always may have had a gentleman's agreement that he gets this or she gets that, but that's not the applicable way of what the original document says. But a very important thing, though, Melissa, it would behoove them to take the step towards mediation before going to court for a whole host of reasons, as the attorneys and people know. And also, the biggest thing we're seeing with now the dissolution is not the legal world, it's actually the medical practices. And so you have to go into there and say, okay, what do they understand? And they may not understand the even the terminology utilized in a business valuation. And that's why it behooves us to document it in detail, but so a layman can understand it. We may not use a sophisticated approach or focus on discounted cash flow, net present value, free cash flow. Just walk them through it. Say, here's why the agreement, you're going to get X%, and here's why you didn't get X% in the last couple of years. How do we catch up for that? In an illustrative example. It's just going through the process as a whole. The one group, I think the biggest challenge group they're having with the partnership is an engineering group. It's when you deal with a lot of these individual professionals that may not be business people per se. They all have their own special niche, and yet they're forced to dissolve the partnership or the entity, and they have to take separate paths. And sometimes taking separate paths is totally different. One may take a separate path because he or she needs to exit. The other one is they want to take the separate path because they want to acquire other companies and do other things. Well, the valuation, the whole objective of this exercise is totally different. You have to understand that and appreciate that with the individuals.
Well, and I think that you brought up a couple different things. And this is probably going into, some of the challenges that we would typically encounter in valuations during partner disputes, is some of these issues are health related. And they're health related, and everybody would be like, oh, okay, well, this is easier, like they're all coming together to try to solve this. No, it's actually, yes, it's easier in some realms, but it's not easier because everybody's trying to be like, oh no, is that fair enough? Oh no, well, I don't know. And there's more unease with the numbers because everybody wants it to be fair. Everybody wants to be considerate, especially if that exiting member has a serious health. They're usually like, well, I want to make sure it's okay for the family. All of these things get involved with it. And we're still talking about how to value it, what to do, educating them when everybody needs to be educated, and kind of telling the good, bad, and ugly with that education. What other issues and challenges are we facing when we are transferring like that? And, one specific one that I think is that in a lot of valuation world, we default to like a DCF. Everybody wants a discounted cash flow model. They want to project everything into the future. And in partner disputes, the reality is most of us would be more comfortable, just as people, as looking at the history. So more of a capitalization of earnings, like what has happened in the past, what does that show for what's happening in the future, and is it the same or different? But that, I think, is one theory place that is a struggle for most practitioners, in my opinion. But maybe
no,
not.
that's you're spot on. It's two very germane points you mentioned. The dissolution is not an island. Something caused it, and you have to understand that in the path that they want to go forward. The second thing is when you use the discounted cash flow, it assumes that the entity is going to go on ad infinitum, and we even have terminal values, et cetera, to accommodate that. But the partnership's not going to go on. When one of the partners leaves, it's a new partnership. Let's suppose we have 6 doctors in there and they're cardiologists, and one of them's going to retire or go off to the university and teach. Well, guess what? You have a new partnership after that. So it's the end of it. It's not going to go on ad infinitum. So you're right. You have to pick the right methodology to use that satisfies the unique things, and understanding why it's not an island, what's going to happen after. And I think one of the most challenging aspects of the entire process is the intangible cost. Often it happens, especially if you want to take an engineering firm or law firm, for example, is the senior partner is the rainmaker. Yeah. Now, he or she may not even be practicing law on a day-to-day, but they bring in all the big clients. Their name's on the door. They're the rainmaker. So what's the value of that? Especially the challenge becomes if they're really not retiring, but they're going to start their own firm or go with somebody else. Then you got to say, okay, what's the name worth? What's everything worth? All these intangible assets. And it's very important. I know from the corporate world that 25 years ago, 17% of the assets for small businesses were intangible assets, 17%. Last year, 2024, in the analysis, 70% of all assets today are intangible assets. It's 4 times as much, almost.
I mean, it makes so much sense. Like, we're in the era of the side hustle. We're in the, I mean, even in our own valuation industry, for the most part, you go to a big firm, you come out and you have your own, private practice, and you partner with some other people, or you don't. But all of this, like even right now, we see a lot of people just buying in partners over time, right? One partner, because if one partner is going to exit, then we need somebody to come in. In this process, again, this entire conversation surrounds, well, we want to look to the future of what the value is. And I'm like, well, do these people want to buy in on a value that they are actively increasing over time, right? Or do we want to look at a metric? Because I think consistency is key. Like, if you're going to start buying in and out partners, do it in a fashion that you're going to be transparent and consistent over time, right? Which means everybody needs to know how you're doing it so that they can know kind of what they're going to be buying in. And then you do a practice every year to do that. That's not what people are actually doing. Like, they're not doing best practices, right? They're start a partner, 15 years later, they're like, someone's sick. They got to exit. What do we do? And they come to us, and they come to other people, and there's 1,800 different ways to go about this, but they're seeking a way that makes them whole, as opposed to sometimes the valuation practice will put more walls between people as opposed to bring them together, right?
Yes. And when they bring them together and they have to separate, the worst experiences, I think, is when people say, okay, there's voluminous literature written on this. If you have a professional organization, and that's primarily what we're talking about today, and you say, for example, accounting firms as 1 times or 1.1 times revenue. Well, if you just take that number, multiply times your revenue, shame on you. That's the national average. Are you saying your firm's average at best? What is the growth potential? What's the characteristics? Why is the partnership to lose? It's the information that goes beyond that one number that is really your intrinsic value. That's what it's all about. To not do the analysis of the industry as well as the individual characteristics of a professional organization, that separates the men from the boys, for lack of a better term. If someone just gives the multiple and the multiple alone, well, be careful what you get. It's not characteristic. You got to take a look at the partner, the human capital, your client base, your contracts you have with these. These are all very, very important factors of the valuation. not just the revenue per se of last year. It's a part and a critical part, but it's not the sole issue at all.
Yeah, like for example, we have 3 valuators and they all come in and they do, various ways of valuating the company. DCF, cap of earnings, build up model, WACC, what risk factor they use. And all 3 of these valuation firms, we'd be like, oh, okay, they have similar methods, similar models. And then you say one of those firms is backed by AI run models in the background, or they have an app that they're sanity checking their own work with AI. And it's one of those 3. Does that change the value? Even if, as you listen to this, are you like, wait a second, which one of the 3 does that? Because that would be really valuable. That's what's happening in the world. It is, it is shifting towards more based on personal goodwill, which for the most part, companies have tried to avoid having any reliance upon the person or the employee, or the partner and the rainmaker. And right now we are having a challenge. How do you transfer that knowledge skill set, or how do you build an infrastructure that will allow you to continue that infrastructure in some way? Those are big questions, right?
Those are big questions and paramount questions, because in a service company that we've been focusing on during this podcast, Melissa, the people are the most important thing. And how do you account for those people? Do you have a good operating officer? Do you have a good client base? Do you have experienced people? And it's a very complicated issue. A year and a half ago, I wrote several articles for the HR magazine concentrating and focusing on this one thing. And it's ironic, in the accounting world, we've got away from accounting for intangible assets. We really have. But as I alluded to just a few minutes ago, they are now 70% of a balance sheet. So this is what has to be taken into consideration when you're valuing a company. It's very easy to value the cash, the accounts receivable. And if it's a manufacturing entity, you can do the inventory without much of a discrepancy. But when you what's the intangibles worth? What's the name recognition worth? What's the client base worth? What's the people worth? What are all these things? But those are the things that separate you from everybody else. And so you got to have to concentrate and focus on that. As well as go back to your solution. Why is the dissolution occurring?
Yes. And I think that part of our goal is to be that sanity check of the documents, to not necessarily just rely upon it immediately. We had a big manufacturer that had, they manufactured tangible things. Let's say it's lumber, but it's not.
Right.
So let's go with that. And, I'm valuing it. I'm like, okay, I can see the cash flow. Obviously, it's tremendous, maybe 10 million in EBITDA, right? Just crazy business. And they're like, oh, certainly the value is, whatever, 50 million, 100 million. And I was like, yeah, but I have a couple questions. Yeah, there's a lot of value here, but why do you have $50 million of inventory? And they're like, what? And I'm like, yeah. Is this 50 million? I was there and I don't know how much wood costs, right? Or but when I'm looking around, I don't see it. So is it somewhere? Because $50 million worth of wood or whatever this was,
yeah,
would appear to be, very physically somewhere. And they were like, what?
yeah.
How much did you say it was on there? So, this is a big freaking company that number was actually incorrect. And it had just, because everybody doesn't understand numbers as much, obviously the checks and balances were not being covered, but inventory is also sometimes, a yearly process that you actually do a physical inventory, right? And so it was just questioning, because in that case, the balance sheet looked like it was far greater than any value I could get from the cash flow. And so I was like, well, one of them's off. Am I looking at the cash flow wrong, or am I looking at the balance sheet wrong? And sometimes our role is to literally be that additional set of eyes. And we can't even assume that at that level, I mean, there's internal accounting, there's external accounting, there's internal CEO, CFO, accounting department. Like, this is a very large firm, but that's one number that sometimes doesn't change very often, that everybody should be worried about.
And that's a shame, because in that specific industry that you're illustrating here, hypothetically, the price of lumber has changed over 25, 40% since the pandemic. And the second thing with regards to lumber, there is an unbelievable supply chain issue with certain types of lumber now. It's a totally different world, and it's so dynamic. And you have to take those things into consideration when you're valuing any company, especially something like the lumber company. But that just goes to reflect, you got to think outside the box. If you just come out with a checklist and go, yeah, this is the number, of multiplied times this multiple and that, you're going to get these erroneous results as a result of that. And we see it much too often. We do a lot of rebuttals and review of business valuation of other business valuators. And you take, it's almost a cookie cutter approach, and it's a shame. And it does not do our industry as professional evaluators a world of good when you see the same template utilized over and over for different clients in different situations.
And yet, there are times when things are very much alike. And I think that that's where the rubber meets the road, is in a lot of situations. And I've talked about this to a few people lately, like, until you get about 10 years of valuation, and like full-time valuation, because most people in valuation firms or in accounting firms are doing like a valuation a month, right? Or I don't know, a handful a year. Like, if you're not doing this like 10, 20, 30 valuations a month, a week, you're not going to see the nuances that are the same or the nuances that are different. Like, if I'm valuing companies in the same industry over and over and over again, like, I can almost tell, like, oh, wait, like your cash flow, your comparison to even my own companies, I can see that there's a huge discrepancy. But when we're coming in, do you more often feel like you're coming in to do a review of somebody else's valuation right now? Or are you coming in to do straight litigation? Or are you coming in kind of like, hey, we think we want to buy each other out. How could we talk about this? Like, where do you think? Yeah.
I see the litigation part decreasing significantly, and more of the professional organizations are going to mediation. Number one, for the cost. Number two, for the timing. Also, to keep the numbers private. A whole host of reasons for that. We are trying to work with the people, and it's the same report if you're going through two of your three analogies in there. If someone say, okay, I want to do a sale, well, that's a good sign to do the valuation. You don't have the risk associated with it. Who's the rainmaker, who's not. You just look at the agreement and the potential for the sale and who gets what. It's a little bit more straightforward. When the company, the organization, the partnership is dissolving, you got a lot more unique characteristics. And it's exactly like you said, Melissa, by doing these hundreds of these, you get to see the little tricks. There's not much that probably hasn't come across my desk in the last 30 years that say, oh, wow, this partnership, has someone thought of this? Or what about this buy covenant? This has changed. Is this even enforceable anymore? There's a whole host of characteristics one needs to be cognizant of to really specialize in this area.
Well, and I think that, unfortunately, we're trying to keep these things short. But what I think we've identified, and we're going to give maybe a prelim of the case study and talk in more detail about it next week, this specific, because you have a bunch of examples, and we're literally going to go through them over the following weeks and go through each example. It has a bunch of things that we can all learn. But I think just in going forward, just our community should understand that we're still creating podcasts, on experts and different experts in different fields. But this is really going to be a little bit more geared towards the professionals, and from my standpoint, showcasing how you can be a professional working in the middle of a lot of these partner disputes and be the valuation expert and sort of a mediator in that you're advocating for the number, like you're really working for the company and advocating for the value of the practice. And it doesn't matter who the person is that hires you. And so I think if we get into that mentality, we can look at a lot of these case studies and understand that as we move towards less litigated things, we're going to need to be the experts in the financial arena, and the attorneys are the experts in the legal arena. But that means taking and being very confident in what you're doing, because you might have to tell somebody, I think your $50 million inventory is wrong, even though you have 18 people that should have checked it, right? I get that, but that's a hard conversation to have, as well as like, hey, here's the value to all of you. And we're going to now figure out, because one of the things that I think we need to talk about, and this may be for our next one, is the discounts. Like most of the time, people are like, I don't want to buy the partner out and get less, so maybe we kind of end it with like, how can they find out more about your cases on your website currently, right? And that you already have some of these listed. And if they have ones that they like, they should tell us, the questions that they have. But we're going to be focusing on partner disputes for now, and, hard valuation concepts when you're either working together with the partners or working in separate, because you're going to be going against another valuator, so all of this is for the betterment of our own industry, our own firms, but also ask the questions, reach out to Michael on LinkedIn. We will be reaching out to others as well, but this is part of how we can all work together and help each other out. Do you have anything else to add, Michael?
Yeah, the only thing I want to thank you, Melissa, for this podcast. And the other issue is the courts are recognizing people need to be an expert in this area. You may have a great CPA firm or CPA that you work with, but they are not experts in this sector of business valuations. Use an expert. I've been a CPA for quite a few decades now. When it comes to tax returns, I have someone else do my tax return. I am not an expert in tax returns. Don't be bashful about reaching out to people who are an expert. Either we could work with your CPA firm or take over the cases. Every case is different, but pick the right team. That's all I'm saying. Pick the right team.
Yeah. And people that you're working with, if you're dealing with litigation, mediation, arbitration, or any of these things, do not assume that a practitioner has experience in those areas. What we've noticed is the valuators or the financial people have more access and see more things in mediation than maybe other practitioners. But we're going to share a lot of our experiences and check back, hopefully every week, but at least several times a month, to this additional series that will help you and ask questions. If you have questions, if you have case studies that you want to talk about, maybe you could be our guest in the future. You never know. So thank you, Michael, and I'll look forward to talking about the actual case studies in the future.
Thank you very much, Melissa. Have a great day.